Two people each have exactly $100,000 sitting in a brokerage account. Same year, same starting number. Person 1 puts every dollar into one boring index fund and doesn't touch it for 5 years. Person 2 spends those same 5 years picking individual stocks, reading earnings calls, chasing the next big name, moving money around every few months. Guess who has more by year 5? It's not the one you'd expect if you've ever watched a finance channel celebrate a lucky trade. There's a real answer to this, with real numbers behind it, and it's not the answer most people assume. And it's not the last surprise in this video either. Here's what nobody tells you once you actually cross that first $100,000. The question changes completely. It's not, how do I start anymore? It's, now that there's real money moving, what do I actually put it in? And that's a much more expensive question to get wrong. At $10,000, a bad pick costs you a bad year. At $100,000, a bad pick can cost you a decade. So we're testing the 3 things people actually argue about at this stage. A plain index fund, picking stocks yourself, and real estate. Same amount of money, same 10 years, nothing but the real numbers. No course to sell you at the end of this, just the math. And the math doesn't land where you'd expect. Quick thing before we get into it. If you're new here, hit subscribe now, because the video on what changes again once you cross $500,000 is already coming, and this one sets it up. And the obvious disclaimer, this is education, not personalized financial advice. I don't know your situation, so take this as general principles, not a portfolio recommendation. Okay, let's start with the boring option, because boring is about to look a lot more interesting. At $10,000, it barely matters what you pick. The dollar amounts are small enough that even a bad year doesn't really hurt you, and a good year doesn't really change your life either. Once you're sitting on 6 figures, every percentage point is a real number. 1% used to be $100, now it's 1,000. Run 2 strategies side by side for 10 years. One averaging 8%, the other averaging 5%, on the same $100,000. And the gap by the end is well over $60,000. That's not a rounding error. That's a car or a year of rent, or half a college fund, sitting on the table because of a choice most people never actually run the numbers on. Quick honest caveat, those specific numbers are an illustration built on historical averages, not a promise about what any of these will do next. That's why this decision gets harder exactly when people start feeling like they've made it. More money doesn't just raise the stakes on the upside. It raises the stakes on getting it wrong. So which of the 3 options people actually reach for at this stage holds up once you run the real numbers? Start with the boring one. A broad index fund, something that just owns the entire stock market instead of trying to beat it, has historically returned somewhere around 8% a year on average, using a conservative real return estimate after inflation. No stock picking, no timing, and the fee is almost nothing, often a few hundredths of a percent a year. Compare that to a typical actively managed fund charging around 1%. And on $100,000, that's roughly $1,000 a year in fees versus around $30,000. Doesn't sound like much in year 1. Over 10 years, with that fee difference compounding right alongside your money, it quietly costs you somewhere in the range of $10,000 to $15,000 for a fund that, on average, doesn't even beat the index it's competing with. It sounds too simple to be a real strategy. That's kind of the point. A single index fund built around something like the S&P 500 hands you a small slice of roughly 500 different companies in one purchase for one tiny fee. You're not betting on any one of them surviving. You're betting on American business as a whole continuing to grow, the same bet that's paid off across almost every rolling 10-year stretch in modern market history. But if it's really that good, why does almost nobody stick with just this? Because the moment you tell most people, just buy the whole market and wait, it feels like leaving money on the table. So they try the other option. Here's the uncomfortable part. Study after study on actively managed funds, professionals doing this for a living with research teams and decades of experience, shows that somewhere around 85 to 90% of them fail to beat a plain index fund over a 15-year stretch. Not most years, most of them over the long run. And that's the pros. Individual retail investors picking their own stocks tend to do worse than that, for a reason that has nothing to do with intelligence. It's behavior. People buy after a stock's already gone up, out of excitement, and sell after it's already dropped, out of fear. There's a well-known case of a legendary mutual fund that averaged 29% a year under its famous manager, one of the best runs in market history. And yet the average investor in that same fund only walked away with about 7% a year. Same fund, same manager, a fraction of the return, just from bad timing. Not because the fund failed, because investors kept jumping in after a hot streak and jumping out after a rough quarter, buying high and selling low over and over, until the timing alone erased almost all of the advantage the fund had actually earned. That's the real risk in picking stocks yourself. It's not usually the picks. It's what your own emotions do to the timing. So if trying to beat the index usually means losing to it instead, does that mean the answer is real estate? Not exactly. Real estate looks completely different on paper because you're not just investing your own money. You're using the bank's money too. Put $100,000 down at 20%, and you control a $500,000 property while only tying up a fifth of its value. That's leverage, and it can genuinely accelerate how fast your equity grows if the property appreciates. But here's what the real estate made me rich story usually leaves out. Vacancy months where nobody's paying rent at all. Repairs that show up the same month as the mortgage. Property management, if you're not the one taking the 3 a.m. call about a broken water heater. Run the honest numbers after every one of those real expenses, and a lot of rental properties net a lot less than people expect. Anywhere from the low single digits to negative, depending on the market and how honestly the expenses get counted. Not the 20% some course is trying to sell you. The leverage is real. So is the phone call at 3 in the morning. Here's the number that matters though. If that same $500,000 property only appreciates a normal 4% that year, that's $20,000 in value gained on a $100,000 down payment. A much bigger percentage gain than the index fund managed, purely because of leverage. But flip it around. If the property doesn't appreciate that year, or a bad tenant and a slow rental market cost you a few months of vacancy, that same $100,000 can sit flat or even lose ground, while the index fund, day one, is already spread across hundreds of companies instead of riding on one single address. It's not a bad option. It's a completely different kind of job with its own math and its own risk if the property sits empty for a few months in a row. 3 real options on the table now. 3 completely different risk profiles. And only one of them is about to come out ahead by a wide margin. Here's the general shape of it, and it isn't pick one. This isn't a personalized recommendation. It's the pattern that holds up best for most people moving from 100,000 toward $500,000. The core of the money, call it 80 or 90% of it, belongs in that boring index fund, because it's the only one of the 3 that requires 0 of your time and has the best track record of just working, decade after decade. If picking individual stocks genuinely excites you, fine. Carve out a small slice, maybe 5 or 10%, something you could afford to lose completely, and let the rest of your money do the actual heavy lifting without you touching it. Real estate only makes sense once you actually want the second job that comes with it, not as a shortcut to avoid one. And notice what didn't decide any of this. It wasn't luck. It wasn't timing the market. It wasn't finding some secret stock before anyone else did. It was structure. Deciding the split once, and then leaving it alone. Most people burn their energy hunting for the one perfect pick, when the actual leverage point was never the pick. It was deciding the percentages up front on a day when nothing exciting was even happening, and then simply not touching it for years. But here's the part that's going to surprise you. The math that gets someone from 100,000 to $500,000 is not the same math that works after that. Because somewhere, past $500,000, a new problem shows up that nobody at this stage has ever had to deal with. So here's where that leaves us. At $100,000, the decision that matters most isn't which stock to pick or which property to chase. It's realizing that a plain index fund quietly outperforms most of the alternatives people reach for instead. Individual stock picking loses to the index more often than it wins, and usually for behavioral reasons, not a lack of skill. Real estate can work, but only once you're honest about the job attached to it, vacancies and all. And the boring choice, held long enough without being touched, is the one doing most of the heavy lifting the entire time. If you've got $100,000 working right now, or you're closing in on it, this is the part where the plan actually matters more than the picks. So stick around for what happens once that number crosses $500,000, because the math changes again, and almost nobody explains why. Tell me where you've got your money sitting right now. Index fund, stocks, real estate, or some mix of all three. And I'll go through the comments on this one myself.